Been called one of the most disruptive and innovative forces in the ETF world today. She's also one of the most successful. Cathie Wood's signature Ark Innovation Fund returned an astounding 148% in 2020, and she says there's still a lot of runway ahead. Cathie's the founder, CIO, and CEO of Ark Invest, and she's with us now in our ETF Edge along with Bob Pisani. Cathie, it's nice to see you again. Welcome to Halftime. Bob, why don't you start us off?
Cathie, great to see you, and what a tremendous year it's been for you. You now have over $50 billion in assets under management, and your flagship Ark Innovation Fund's up nearly 20% this year alone. But I've got to start with your biggest holding. It's Tesla in the Ark Innovation Fund. It's also in the Next Gen Internet Fund. It's also in the Technology and Robotics Fund that you run. How do you feel about Tesla's price now, and are you still adding to your position?
Yes. Well, as you know, we report our trades every day, and you will see that we have been adding to Tesla. Our confidence in Tesla has grown as we've done research on what ride sharing potentially could add. It could limit the risk significantly. It's a much more profitable business than electric vehicles. And we do think, even though I think there's some debate at Tesla whether or not they should launch a human-driven ride-hailing network, it would be a very good bridge, we think, to their autonomous strategy, and we think they will decide to do that. I don't think anyone has in their models anything for ride-sharing. And then as time goes on and we learn about their artificial intelligence expertise, the 30 billion miles they've collected of real-world driving data. No one comes close, not even, I think Google might be at 30 million compared to 30 billion. And we know that in the AI world, and autonomous is AI, that the company with the most data and the best quality data will win. So we're pretty excited about autonomous, and the probability of success in autonomous we believe is going up, and therefore our price target will probably follow at some point.
Okay, and Bitcoin is on everybody's mind right now. Your Next Gen Internet Fund has a very large position in the Grayscale Bitcoin Trust. So your thoughts on this? Your thoughts on Bitcoin, a Bitcoin ETF for 2021, is it coming? And do you have any concerns that the Grayscale closed-end fund still trading at a pretty significant premium?
Well, the premiums come down quite a bit. I think now that we know that the next SEC commissioner is going to be David Gensler, who spent the last few years at MIT teaching a class about blockchain technology, Bitcoin. I think he understands the technology and he understands the currency itself. So I think the probability of an ETF has gone up. We also know that the director of research for crypto in the crypto space at the SEC has been promoted and will be reporting directly to Gensler. So again, I think we have individuals now involved who really understand the space. And I think the likelihood has gone up. What has surprised us, we expected institutional interest to pick up this year, and it certainly has. But the way in which it's picked up has surprised us. I don't think we ever thought there would be broad-based substitution of Bitcoin for cash on corporate balance sheets. So we find that very interesting. If all corporations in the United States were to put, I think it's, 10% of their cash into Bitcoin, that alone would add $200,000 to the Bitcoin price. Now, we obviously do not believe this is going to happen very quickly. We're talking about maybe the equivalent of $900 billion market cap equivalent for Bitcoin. That's less than half the price of the Apples and Amazons of the world. So this has to mature a little bit before broad-based adoption can take place. But we're very reassured that companies like Square and Tesla have chosen to allocate. They're on the right side of change when it comes to innovation, and therefore we think it's wise that they diversify some of their cash. And I think the biggest surprise to many Tesla doubters is that it is now in a position where it has that much cash that it is diversifying.
Now, you've been directionally right on a number of other big stock bets, including Teledoc. This is your largest holding in the Genomics Revolution Fund you run. It's also a big holding in the Innovation Fund. It's up about 40% this year. It's got a $40 billion market cap right now. This is telemedicine. Is telemedicine really going to continue to shine once COVID recedes?
Well, we had a great opportunity to buy into Teledoc when the stay-at-home stocks were starting to flatten out as the vaccine was on the horizon. Teledoc was one of those stocks, and it then was hurt by an acquisition it made, Livongo. This is a beautiful acquisition for Teledoc. The most important variable, again, I'm going to come back to AI over and over again, because we think that is going to represent $30 trillion in market cap during the next 10 years. And we are just beginning. So with Livongo, Teledoc now has one of the best artificial intelligence teams and some of the best data. That's the other thing we'll come back to. Most data, best quality data. And we think the combination of Teledoc and Livongo is going to be a powerhouse. One services more the acute setting in medicine, and that would be Teledoc itself primarily. And Livongo is more involved on the chronic side. So chronic conditions, kidney conditions, mental health, and so forth. So we believe that with this data, these two companies, now that they're together, now that they put their AI teams together, are going to be able to make help make the healthcare ecosystem better, cheaper, faster, more productive, more creative. What we say about all kinds of innovation, they're in a beautiful position to do this.
Cathie, it's not just Teledoc. This is Scott now. It's not just Teledoc out of your signature innovation fund that has enjoyed spectacular gains over the last year. I'm looking at the list of your top holdings, whether it's Spotify or Shopify or Zoom Video, for example. The gains have just been tremendous. I'm wondering what happens when we get on with the rest of our lives after COVID, and how do you think about taking profits, even though I know your typical sort of outlook is a 5-year time horizon? That doesn't mean you can't take profits every now and then and redeploy capital elsewhere to some of the laggards, perhaps. How do you think about that?
Sure. Well, the last year has been instructive. During the coronavirus crisis, we consolidated to our highest conviction names, especially those that were tormented by, I would say, algorithms who were looking for small cash cushions and cash burn. And so we had great opportunities to buy stocks at a fraction of the cost from just a month earlier. Certainly Invitae and Zillow were two of those stocks. And then they've had magnificent runs. Many, Square would be in this category as well. Many are up 5 to 10 times. Tesla is also in that category. There was a lot of fear about its condition. And then what you saw was the stay-at-home stocks start to flatten out. So toward the end of last year. So some of the stocks into which we had concentrated our portfolios, they were up, as I mentioned, 5 to 10-fold. We started moving back into these stay-at-home stocks because it seems to us that many analysts and portfolio managers believe that after the vaccines make it through our population and the rest of the world, that these stocks will be done. We actually think that innovation makes the world a better place generally in the ways I described earlier, and that the coronavirus has accelerated the shift towards these new ways of doing things, these new ways of spending time. So we were happy to get the reprieve in some of these so-called stay-at-home stocks in the last, I'm going to say 6 months. It really started in July, August, giving us time to move out of some of the names that had taken off and into those that were marking time. So that's what we do. We are considered a liquidity provider, which means when people are selling, we will be buying. And when people are buying, and these are investors and retail and institutional, we are likely to be taking profits, as you say. Taking profits is never a bad idea.
But can you envision owning, for example, a Zoom in 2 to 3 years? Or will you have moved on to something else because the world has changed?
Well, I think the world is changing because of Zoom. And I think we're going to be working very differently in the future. Sure, there's going to probably be a combination of in the office and stay at home. But now we know it's possible. We look at Zoom in the context of the tech stack. And if you look at the tech stack, the enterprise communications layer is the biggest. It's a $1.5 trillion layer. This is where Zoom is playing. And they're starting to add features to their services. And I think all of us will agree, my experience with Zoom is it is the best platform for video, is the easiest user interface, and I do believe that it will pull away from the pack.
Let me ask you about Palantir, which we just found out you've added to. Can you tell our viewers why you added rather significantly to your stake in Palantir?
Yes, they reported yesterday, and the stock was down on the report. It's interesting to listen to the CEO. He was speaking our language. He essentially said to investors, you know, we are playing in a massive space here, and we're going to invest aggressively now in order to capitalize on the exponential changes that are taking place here. So if you are short-term in your focus, you probably don't want to spend too much time investing in Palantir. So that's music to our ears because, and we do believe more and more companies are going to start behaving in this way instead of catering to short-term time horizons and we would say, in some cases, short-sighted shareholders who are much more interested in profits now, dividends now, share repurchases now, than they are in a company investing aggressively for going short-term profitability in order to really catch some very big waves out there. So I'm astonished. Their revenues are still 61% government, but I've learned, and I think most people in the innovation space have learned over time, that some of the most important innovations in our lifetimes have started in the government, especially in the defense sector and in the intelligence sector. So we think in many ways, and they won't talk about how, but they're certainly garnering a lot of business, which tells us that they are seeing in the future and investing in the future in ways that companies, governments, but increasingly companies are going to need, especially as we're competing against China. I think we've been, again, with this short-term time horizon, we have not been spending enough in innovation. And so, you know, Palantir's attitude is refreshing. It's exactly how we invest. We want our companies to invest aggressively. We don't want profits now. We want them to invest aggressively because we're moving into many winner-take-most markets. And the autonomous taxi world is a very good example of that. That is why our confidence in Tesla, going back to the largest position in our portfolio, is so high.
I'm going to ask you about more stocks in just a moment. You spoke of a lot of the stocks in the flagship fund as having a longer runway than maybe, you know, some would suggest the pandemic would say. It seems undeniable to me, though, that you must be thinking about the impact of higher rates on the kinds of stocks that have been tried and true winners for you all throughout, whether it's the Signature Fund, the FinTech Innovation Fund, and even other areas of the ETFs that you have. Are you worried that as rates go up, those stocks could come down?
Well, I do believe if rates were to take a sharp turn up, that we would see a valuation reset, and our portfolios would be prime candidates for that valuation reset, of course. Now, one of the things that I found interesting over the last really 20 years is that the S&P's PE ratio tends to peak out in the 20 to 25 times range of the forward earnings. And I think the reason for that is most portfolio managers and maybe quantitative researchers are looking at normalized nominal GDP growth in the 4 to 5% range, which is where long-term interest rates should be normalized. We actually think normalized GDP growth is probably closer to 3. Now, if you think, and that's where long-term interest rates should stabilize. If you think of 20 to 25 times, that's 1 over 4 to 5% growth. So it's the inverse of the growth rate, the nominal GDP growth. And that's where it seemed to be peaking out. We think there's actually longer term. I agree with you, Scott. There will be a valuation reset. There will be fear, I'm sure, and we will use it to our benefit, concentrating our portfolio to our highest conviction names. But I think longer term, especially given the powerful growth trajectories that the 5 innovation platforms around which we revolve all of our research, that those trajectories are so powerful that these multiples, these companies are going to grow into their multiples a lot faster than most investors are now expecting. And so that's a source of confidence for us.
Steve Weiss has a question for you, Cathie.
Hi, Steve.
Hey, Cathie, good to see you again. So my question plays off what Scott just asked you. Do you take into account, or do you have any type of forecast in terms of rates and adjust the portfolio to that forecast, or do you keep cash there? And ETFs are kind of interesting in terms of the level of cash you're allowed to keep or not keep. So how do you do it? So rates right now, they're moving up. Do you say, okay, we may be in a little trouble here with this valuation reset. They're going to jump up another whatever up to, maybe 2%. Do you get in front of it, or do you just take it as it comes?
No, we use it, actually. And so what we've been doing for the last 6 months is expanding the number of names in our portfolio. And we do that as a bull market extends, because in some ways it's a tax-efficient strategy. What we will do during a correction, especially a severe correction like the coronavirus crisis presented, we will sell names in which are creating losses now because, again, we've bought them, we've diversified and bought them more recently. Sell those names creating losses to buy our highest conviction names. Some of the names we've been moving into, you'll notice, are names like some of the bigger biotech names, Regeneron, Novartis, Takeda. And what we will do and we think of them as cash-like, but there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because these companies, the ones we are choosing, they are able to use the convergence of technologies that is taking place today in the genomic revolution. So DNA sequencing, artificial intelligence, once again, and gene therapies, new technologies, new ways of doing things. They are investing aggressively now. They have to, because they've lost a lot of their pipelines or will soon do so. And we think the returns on investment in the biotech space, and I'm talking big biotechs, if they're doing this correctly, could move from the high single digits today back into the golden age of healthcare. So in the 80s, we saw 20 to 30%. So we're using them as cash-like instruments in some way, because we will move back into our pure play names if we get into a severe correction. But we also see the investment merit in these names. They're just not pure play names. So we we use corrections toggling back and forth. And so right now, our flagship portfolio has roughly 52 names in it. At the low point in the coronavirus last year, it was as low as 33, I believe.
Cathie, Bob's going to wrap it up with you. I have one quick question. What do you view of the SPACs right now? Would you ever invest in these SPACs?
We are investing in them.
Which ones?
Not all of them. We think there's, DraftKings, Skills, Butterfly, that merger was just consummated today. Blade, which I think is still going under the name Experience, so that acquisition has not been consummated yet. So yes, we're being very careful. We don't like the opacity in some of these SPACs, and nor the incentive system in some of them. But this is a way for venture capital to have liquidity events sooner than might otherwise have been the case, giving the public markets an opportunity to invest in some innovation-oriented names much sooner than might have been the case with just the IPO process. We understand the questionable nature of the compensation schemes in some of them, though.
Interesting.
Mm-hmm.
Cathie, we've only got a couple minutes left, so I'll need a quick answer. We want to ask you about something that's exciting a lot of us here at CNBC, and that's the Mars landing tomorrow. It's going to be one of the great technology feats of all time. I know you filed for a space ETF. Can you tell us what excites us about space? You said earlier in December it's important to get on the right side of change and stay on the right side of change because it's hit escape velocity. Is that what this is about? Is space another part of that whole change paradigm that you keep talking about?
Yeah, we do put space into that category. We will not, I can't say anything. We're in the quiet period when it comes to the fund itself. You have to wait until the SEC deems it effective. But yes, the right side of change. And the reason is always the same. The costs associated with launching, with rockets themselves, with antenna, they're all coming down dramatically, thanks to both the private and the public sector. But I think the private sector has really helped NASA out here. You've got Elon Musk, you've got Jeff Bezos, you've got Richard Branson in another way. And on the technology side, we see SpaceX and Blue Origin pushing the envelope. So costs are coming down and the technologies are finally ready. I think the reusable rocket that Elon, many people were saying, why is he doing that? Why is he doing that? And of course, now we know the only way he's going to be able to get to Mars, or whoever the first people are, we are going to need reusable rockets to do that. And so, again, it's always about cost.
Right.
Costs are collapsing, and it's always about technology being ready. So, yes.
We can't wait to find out the names that are going to be in that ETF when the time is right to do that. Cathie Wood, can't thank you enough for spending the time with us.